move to our first panel of the day, will center around the theme, the Great Indian Startup Reset, eyeing profitability, corporate governance, and IPO. While they're setting up the stage, may I invite our moderator, Manu Toms, Executive Editor, ET Prime, to come onto stage. Manu. With that, may I also invite our panelists, Pranav Pai, Founding Partner and Chief Investment Officer, 314 Capital, Swapna Gupta, Partner, Avaana Capital, Abhishek Goyal, Co-Founder, Tracxn Technologies, Ritesh Banglani, Partner, Stellaris Venture Partners, Mohit Jain, Head, Transaction Banking Group, IndusInd Bank, and Abhijeet Jhawar, Vice President, Corporate Strategy, Infra.Market. Manu, you have 35 minutes to tell us more. 35. The mics are on, just go ahead and speak.
Yeah. Okay. Good to see so many familiar faces and some of the new faces too. We have been with some of you and I've been talking for years, and thank you for the conversations on and off the stage. And for the theme today, profitability, governance and IPO, our respected speakers in the inaugural session have set the context very beautifully. So without much ado, I'll probably go into the topic. We know that the venture world, as far as profitability is concerned, it's the venture is driven by the principles of disproportionate growth and disruption. So how far are we wedded to the idea of profitability in the early stages? So I would actually go to someone like Ritesh, who has seen at least a couple of funding cycles and 3-4 economic cycles. So at the site of every downturn, the concept of profitability surfaces in the startup conversations. So would like to understand what are the nuances to the profitability when it comes to venture investing.
Right. Hi everyone. This is a topic that is very close to my heart because, like Manu said, the specter of profitability arises every time there is a downturn. But the fact is that profitability is why we are all here. It is the purpose of existence of a company, a corporate, is to generate profits and returns for its shareholders. And so it's not that profitability is not important in any cycle. It is just about how long people are willing to wait for that profitability in different market cycles. So I would like to argue the other way, that there is a danger to expecting profitability too early in a company's evolution. And for that, I would like to explain the venture model for a minute. That venture capital is different from every other kind of capital because it provides a massive amount of fuel for companies to grow really, really fast before they can start generating those returns, to fund the losses in the initial few years before they can start generating profits. Sometimes the pendulum can swing too much in the other direction, that if too early in the cycle, we are now starting to hear investors asking for profitability in Series A. To me, that is self-defeating, because if the company were able to go profitable very early, every company would do so. Unfortunately, there is a trade-off between scale and profitability in the early stages of a company. And so, at least to me, it is extremely important that we provide our companies that space to experiment, to find product market fit, and to figure out scalability before we insist on profitability. So in a nutshell, to me, it is the objective of every company to generate profits. However, we need to be patient in the early stages and give the company space to prove product market fit first before insisting on profitability.
Pranav, I'll go to you. So, do you also see the emphasis on profitability at series at very early stage, like Ritesh has just said? Yeah.
Yeah, no, I think Ritesh got it spot on. In the early stage, what do we want to see? We want to see there's a differentiated product here that customers are willing to pay for, right? Now, when they pay, you have to understand startups will sometimes price it lower so they can get more customers to say yes to a new way of doing things faster, right? Or if it's a B2C product, zoom back 10 years, people were still uncomfortable by paying for something on Flipkart and waiting 3 days for the hope that it will come to your house. It's a very new thing for people, right? And for hopefully 100 million people, like they were targeting back then. So discounts and other ways to earn trust and spending money on ads and sponsoring cricket teams and so on. So I think the assumption that startups don't know what they're doing with the massive amounts of capital that they raise, I think that is a wrong assumption. I think there's a really clear reason why capital needs to be spent a certain way. Now, the demand for profitability, however, has to be stronger on year 6, year 7, year 8. As these companies are reaching a certain size, the public markets very clearly reward you a certain way if you are showing EBITDA growth or PAT growth versus just revenue growth, top line growth. Abhishek here has taken his startup profitable. He's a living example of how the markets reward you as you're showing a different type of growth on a different row on your P&L. So I think we have to take contexts for capital very clearly. And of course, as market cycles change, one of the most important things, the risks we deal with in the early stage is our companies need to last through these cycles, right? We're 10-year funds, some funds are now 15-year funds. In 10 years, you'll see everything. You'll see wars, you'll see recessions, you'll see good years, bad years. We have to make sure our startups last through all of that. And therefore, this demand for profitability, I think it's also cyclical. We just have to make sure we stay rational through that time period.
Swapna, you focus on a particular niche, clean tech and green startups. So how far this is relevant in your context?
It's actually very relevant when you think about, when you talk to people, climate tech, they end up saying clean tech, to your point, right? And clean tech 1.0, everyone had a lot of scars because nobody made money. The reason nobody made money is, again, there was a lot of capital thrown. Those assets really did not have a great IRR, which meant nobody really made money. So today, as I think about the new era, how we should think about, we are Avaana Capital, we are an early stage fund, which has taken a point of view saying, look, there are cycles which will come and go, but if you think about next 20, 30 years, what is clear, at least to us, is next big trend is climate, because it's something which is a big risk, hence a big opportunity for us, and startups will of course lead the charge. When we think about climate tech, we think about two different set of startups. One is of course process-led, the other is product-led, which is why we have to again think about contextualizing it. If it's a product-led company, for example, it's a deep tech company which has used alternative material, alternative chemistry, alternative mechanical engineering, I cannot forget profitability, even a product in next 3 years, which means I have to be strong-hearted enough to not only ride this round, but the next follow-on round also, because capital may not be available. Again, I think to your point, which you put it very well, profitability suddenly becomes important when down rounds or cycles come through. But when you're investing in a space, you should know exactly what you're getting in. And if shit hits the fan, how are you really going to take care of it?
Okay, I'll go across to founders. So, of course, Pranav had already mentioned you are a living example. So, people would like to know what,
So, I think at the core, company has two goals: solve a customer problem, make money. We can live with the concept of delayed profit, but I think, and I had the fortune of seeing, I working at Amazon earlier, which is a big example of delayed profit. But I think even Amazon was very prudent with how it spent its money. So there was delayed profit, but they never gave discount before they did efficiency. That they would start selling something at a price, and as they have made it more efficient, then they reduced the price. They didn't reduce the price upfront. So they were more prudent in terms of how much they delayed their profit. We went to other extreme in last few years where we saw WeWork and Uber-like plays where we were just through way too much money. So we have to learn to balance this out. So we should be okay with delayed profit, but we should be prudent with not funding it way too much with equity, because equity capital is really expensive. So you have to be very mindful about how much are you burning to get that delayed profit. And you can't throw way too much money if the business can't return that much capital. Because this capital requires the highest rate of return. If you put money in FD, it's let's say 6-7%. If you do index, it's 13%. If you do mid cap, small cap, it's like 18%. This capital requires 30% IRR. So you have to be mindful of how much the terminal profit is in short run, and then you work backwards.
Great. So one of the profitable unicorns, Abhijeet. So back to back, I think so you have shown profits. So can you explain how that was made possible?
Yeah, actually, Infra.Market had to undergo this stress in the first 3 years of attracting capital because we were profitable. Because actually, the investors used to ask, you're already making money and why do you need more capital? And the sector of construction material space was not very, very structurized. In fact, this is one sector which is probably now after we have seen it in banking, then we have seen it in logistics, and technology wave will now come in the construction material and construction infrastructure sector. So I think our need and our focus on unit economics was always there from day one. So we actually got clearly picked out, and profitable unicorns will get clearly picked out when you are very clear about your unit economics. Apart from that, being a B2B company, I think as the panelists are talking, one is about a deep tech product, the other is about building a business for future, but you are going and taking up incumbents which are already sitting on huge amounts of capital, and you have to actually disrupt them. So your need for capital also will be very high, which will not be possible if you are not profitable. And we are getting into big sectors which are pretty big. So I think with that perspective, we were always clear that we have to keep looking at attracting capital. So being profitable is a very, very important thing, and being rationalistic about what you are building, and that has actually helped us be where we are, I think.
Okay, so I'll go to Mohit. So as the team suggests, it's a time of a reset. While we, deliberate on profitability, the fact is that there is some delay in funding. There is a funding winter. So in this context, so do you see commercial banks have a role to play? How is it?
No, absolutely. I think bankers are a traditional lot, but we are also changing our mindset with this large startup boom and the advent of unicorns across the spectrum. And as a banker, I see that while there's been a lot of discussion on profitability, just to share on the earlier point as well, there were close to 109 or 110 unicorns in our country, and of which data was available for around 80, of which the profitable unicorns were around 16. So if I put it into percentage context, say anywhere between 10 to 20% of the unicorns themselves were only profitable. And if you add the number of startups, which was earlier shown in one of the presentations to be above 100,000, right? Then obviously, to my mind, the number cannot be any better. It would be lower only, right? So bankers are also trying to see it with a different lens or prism as to how to evaluate the landscape of startups, how to support these startups, which could be not from a traditional balance sheet mindset. It could be with a cash flow funding perspective, structured solutions, and giving the entire gamut of or bouquet of banking solutions to these startups.
Okay, we'll move to the next topic, that is governance. So we at ET Prime recently did a story on harder term sheets. So, we have even come across that even asset liability gets, comes into the play when it comes to the term sheets are being built. So are the term sheets really becoming harder in the context of, say, the governance issues that we keep seeing? Ritesh, what's your insight?
So again, my view and my firm's view is that we should not overreact to some of the high-profile stories that have come out. There are certain lessons to be learned, and as a result of those, there are some processes that we have tightened. So where we would start internal audits in a company when, let's say, they would be $25 million in revenue or so, we have brought that forward a little bit, to when, let's say, a company starts generating around $10 million of revenue. But again, the scope of internal audits in our companies is actually not to catch any governance issues. It is to strengthen the processes for the company itself to catch those governance issues if they happen. Second, we have typically instituted audit committees on the board of our portfolio companies so that the non-executive board members have a direct line of communication with the auditors. We have started doing a little bit more of reputational and ethical diligence on founders prior to investment. But even there, we are not doing it on 100% of the cases, because we'll never be able to close a deal if I'm spending 2 months doing a reputational DD on every founder. But what we have done is we have expanded the scope of the risk factors where we would do that kind of diligence. So while we have taken some of these measures, I'm also very cognizant that we should not overreact and burden a company with compliance and governance processes just because a few high-profile cases have come out. The vast majority of founders are ethical. The vast majority of founders want to be both compliant with law and with best corporate governance practices. To us, it's more a matter of coaching them and giving them the tools to catch issues in their companies before they become large. We definitely do not treat every portfolio founder as a potential criminal who's intent on defrauding the company. So that's not at all the intent.
Okay. So Pranav, what's your experience? Are preemptive conditions come into play when it comes to building term sheets?
Yeah, I think we think about the instruments we use today. Do they scale in the future? So now in our portfolio, for example, we've closed 240, 250 follow-on rounds. We've followed our companies from seed to IPO. Of course, our portfolio companies raise a lot of equity capital, billions of dollars now. We've definitely seen that if there are any kind of over complications too early, in a term sheet, in lick pref, if you take 27-30% ownership in the seed stage, those companies have not worked. Clearly, there are things that when you go to the market rejects you outright. Right? And I think on governance as well, if you have overcomplicated certain situations, if you made it untenable for a founder's time to be spent on building value, growing the business versus just covering his backside, I think you've set up for failure. Right? So I totally agree with what every VC is saying today. The reasons these things exist is because all of us are fiduciaries. We want to serve the company's best interests. And sometimes if even the founders are not in the company's best interests, that's only when you evoke the worst case scenarios. Right? That's what they're there for. Those are not rules for everyday corporate governance. Those are exception handling routines. So I think seeing the exception handling routines at play today in very few, 4 or 5 companies out of, 100,000. I think we shouldn't extrapolate too much to the rest of the 100,000 either. So I think, again, it's a context of today's headlines. I think long-term we're building companies, certainly very good quality companies for the long term.
So now, what is your take on the governance?
So, interesting question. For us, I think it's not about the new normal, but it's actually going back to the normal, which is basically what, because of the frenzy of the ecosystem, I think we saw the charts where suddenly 4 quarters, there were 50 unicorns created, etc. Right? There was unnecessary momentum in the ecosystem, which means everything which moved got funded, which is why in the hurry to get things done, there was slight looking sideways where the term sheets came with non-standard clauses and it was acceptable. I think what has happened is we've just gone back to the normal where we're saying, look, these are table stakes, the bar cannot be lower, and this has to be, and we have, in our case, I think in last 12 months walked away from 2 deals where we did not think that the founder ask was standard. It was very, very non-standard, and we were, as our fiduciary responsibility to Pranav's point, not comfortable accepting.
So, Abhishek, so you've run company, so you're running a company, so what's your approach on the governance? What are the strictures that you put in place?
So, I think I resonate with a lot of what Pranav said and what Swapna said. Look at public markets. They have all the governance in the world. You can't put more compliance on a private company than a public company. There also these cases happen. Every year 1 or 2 cases will come in limelight. Having said that, when you invest in public markets, you don't think about governance as the top thing. Having said that, you also want narrative at early stage itself that, look, governance is important, you have to do that. What I had figured out over time is that it's your behavior in the company which dictates everybody else's behavior. So as a founder, if you set a narrative very early on that, look, we have to respect the law and we have to make sure we are always following it, it goes a very long way. And I've realized that we have to walk the talk, and it starts at the board level where investors have to talk about the elephant in the room, as well as on the founders, they talk to their finance teams and make sure that everybody understands that. So for example, one of the things we used to talk always in early days was that make every decision as if you're a public company. If this is a non-standard decision, don't make it. I'll give a very simple example. If there are 3 people in a team, one person is negotiating very hard on appraisal, what do you do? When you're a public company, you have to have standard guidelines for appraisals. In early days, if you always make an exception for everything, that becomes the norm. So we implemented some of these very basic things very early on. And these things go a very long way. Once you set up ball rolling, everybody starts behaving, and that is how it should be done.
So what's Infra.Market's approach to?
So actually, Manu, I see your question in 2 parts. One is the term sheets have become difficult, and 2 is the compliance and adherence to compliance. I think, yes, many startups did prioritize growth over, and therefore there were certain slip-ups, because as much time as a founder can give in terms of building the company and if you are profitable, maintaining that. So we have, and everybody has had their learnings, and I think, as rightly pointed out by panelists, that we need to not overthink about it. We have made our processes, everybody has made their processes tighter, compliance regulations have become better, and I think that's the way towards how you build a formidable company. The other part, yes, the term sheets have become difficult. That is also primarily because of the market scenario. I think largely the late stage investors, but primarily we see it that way, that the late stage investors have moved towards growth, the growth have moved towards early stage, and check sizes have also kind of started changing. So, and that is probably because there has been not a lot of success stories for late stage investors making the exit the way they would have thought. So I think both these nuances are changing, but as rightly pointed out by the speakers earlier, we will see the turn changing, and India not being in that recession phase. I think better times are ahead, and by default everything will probably get into place.
Okay. So from banking point of view, did these governance issues have any impact in your relations with the startups?
No, absolutely, because I feel that, some panelists have mentioned that we can't overdo it, which is also equally true. At the same time, from a banker's perspective, it's primarily to do with trust building, right? So long as that element of trust is there, which is getting demonstrated by the company, the promoters, the financials, and that's my personal take, that even if there are some breaches of covenants, let's be upfront about it. I think there is far more merit from the banker's perspective of condoning those breaches, rather than trying some jugglery and which erodes the entire confidence, right? So, but I tend to agree that you can't overdo things. you have to be compliant in a reasonable way and, still strive for growth rather than just being compliant all the time.
Yeah. Okay. So now we move on to the last theme of the session. That's perhaps the most important, the exit. So Abhishek, you have done an IPO. So tell us, what was your motivation, probably opting for an IPO at that point in time?
So I think once you raise some external money, eventually that value has to get unlocked. There are fundamentally two broad ways. Either you sell the entire company, or other option is, if you want to build this company for a very long time, if you feel that there's an opportunity to run this company for 30 to 40 years, then going public gives you that platform where you can keep building. And we were very clear from early days that we want to keep building this company. So going public was almost a given. Having said that, if you build a case, look at some of the largest companies in the world. More than 90% are public. So there is some framework that going public provides you which continues that momentum. And some of the things that we have learned while after going public is, we went from 30 shareholders to 30,000 shareholders on one day. So the amount of responsibility that puts on you as a person, you start doing a lot more grown-up things. And secondly is this quarterly discipline. We are all born out of an exam system, right? Every few months you have an exam and you study for it, and that brings best out of us. And there is a very clear quarterly discipline after going public. You can obviously take it negatively, but if you use it in a positive way, it will set you up for multiple decades of continuous growth and progress. That is the single biggest reason of going public. I think third thing is, and which I sort of underestimated before we went public, the amount of pride employees take after you go public. A lot of people came and told me, oh, my father heard about our company and he was so proud of me. That you can't relate to it until you go there, and they are able to cash out their options. So that is a third hidden part which I also realized over time. But these are three reasons which sort of help companies.
Yeah. The last part is fairly unknown, so that's interesting. So Ritesh, so you have seen the evolution of the startup ecosystem for a fairly long time, from Helion days or even before that. So, so 5-8 years ago, when startups were coming on the scene, the idea of exit was primarily around, some big acquisition or even a secondary, buyout or something like that. So, but now we see that, from very early on, it is aligned towards maybe IPO. At least, that's how it looks like, so, and we have seen quite a number of IPOs too. So, is it that, so we are seeing a shift as far as the long-term goal of startups are concerned when it comes to the exit point of view?
Absolutely, Manu. I think entrepreneurs thrive on examples and role models. In the entire, I would say, between 2004 and 2020 or 2021, we saw 3 tech IPOs in that entire 16-17 year period. That was InfoEdge, Make My Trip, and IndiaMart. Then in 2021 alone, we saw 6 or 7 tech IPOs. I think that changes the mindset of an entrepreneur from building to get acquired to building forever. And what fully resonate with what Abhishek was saying, that it frees your mind when you know that you're going to be building this company for 30, 40 years. Your outlook becomes a lot longer term, and in a way it makes you calmer because you know that you are not building for somebody else to acquire you. So you don't have to please somebody else, you just have to create value for your shareholders. And that, on the ground, I can clearly see that happening. Entrepreneurs who have just started, when they are raising their seed rounds, they have this clarity that they want to build this company forever. And that, I think, is a very positive sign for the ecosystem.
Okay. So also the policy framework also have become more conducive for the IPO. So Pranav, what's your take on your experience with IPOs.
Yeah. We've of course, we finished our first one with Abhishek here, and we have at least 4 more in the works, looking good so far. I think we've seen 3 things change. We've seen, first of all, the regulatory mindset has fundamentally been altered by good experiences by allowing companies in the market, right? I think, of course, we are an over-regulated market. That's a truism. It used to be a criminal act in Company Act. You could go to jail for 2 years for a list of things, and the 2-year jail sentence is equal to manslaughter in another act in Indian Penal Code. So we're in a weird regulatory market for sure, but it's that way for a reason, right? It's overprotective for a reason. And now for startups to be able to give in a window to demonstrate that they're capable of meeting public standards. I think having seen that a dozen times now and at least 20 companies in the pipeline, I think all of us are seeing this change happen in real time. So today I think the regulatory mindset has changed. That's a really important step forward. And I think the market regulators will only continue to work with the market to take that better and better as we scale forward. Second, I think the retail environment has fundamentally changed. We're seeing record flows into mutual funds. We're seeing a balance of savings from real estate and gold into equity markets. And there's now a clamor for everyday citizens to buy the stocks of the companies whose products they use every day, right? So today in India, I'm very happy to say, you can order your breakfast on a company that's public on its app. If you like the experience, you can buy the stock of that company on the app of another company that's gone public. This is a very interesting experience. It's how the US was 20 years back, where if you like Google, you use it every day, you can buy the Google stock. If you like Facebook, you can, or Snapchat now for millennials, you can buy the stock on Robinhood, another millennial app. So where we've achieved parity in terms of this retail experience with the best of the world very quickly. I think lastly, we've finally seen a big chapter of Indian startup investing close, right? You can argue with Abhishek and so on in the Flipkart investment in 2008. That's when this modern generation of startup activity really started in India. With Flipkart's acquisition, with so many IPOs, Zomato and so on, Paytm, we finally saw the close of the first chapter, right? And I think that's really important. And that's given confidence to the world's LPs, investors, crossover funds, et cetera, to invest in this story, knowing that it's going to get better from here. So I think it's very good news. We have to deal with market corrections like this. I think, again, it's a context we are used to by now, but it's very positive for what I'm seeing coming forward.
Yeah. Swapna, your previous fund, just had done a successful IPO. So what have you seen, so when you talk to founders, so whether the idea of IPO come very early,
So personally, it's very gratifying because at Qualcomm, we saw not even 1 but 2 tech IPOs, which a lot of funds can dream to think of how can they get in 10 years. So very congratulations to that firm. For me, I think what I think about is all of us are VCs, and I think every asset class is different. There's VC, there's private equity, there's PIPE, there is pre-IPO. For a VC fund, you cannot expect all your companies to go IPO. That is just impractical because you have a fiduciary responsibility. You need to start recycling capital, returning capital by 4th, 5th, 6th year, right? Which means for us, there's a portfolio strategy. Whenever we look at a company, we actually think about it as we invest. We put it in our note, whether we think this is a company which will go M&A, which will be secondary, or will be an IPO. And typically, I would say in any portfolio, if you have even 15 to 20% of your company, which you think can go IPO, I think you have built a great portfolio. But again, I think like Abhishek said, that you think about quarters, you think about how to build the company. If you know those are the companies which will go IPO in 10 years, you need to start building for them in the 4th, 5th year to get to IPO versus 8th year and the next year is an IPO. You cannot build it that way.
Great point. So, what is Infra.Market's thought process as far as, IPO is concerned? Is there something like that in the
it's definitely on the cards. Correct. As rightly pointed out, I think every founder understands there is a right time to go and take it. Like we as a company, we are building India's first multi-category, multi-product construction material product. So right from concrete till modular kitchen. I don't know how many in the room probably would know, but today we need to build scale in everything. Today, while we are in Karnataka, while we are in Bangalore, we are Karnataka's biggest concrete manufacturer and supplier. We have taken over the other incumbent. So that scale has to be built into, say, a electrical, a wood, a plumbing, till modular kitchens. And once, so it took us 2-3 years to reach here, and probably it may take another 2-3 years to build scale in each and every category, and then probably we have built what we aspired for. In fact, I liked what Rajat presented, that from a Soonicorn to a unicorn to a zebra. I think today, if you see our journey also, like from a unicorn, we've put stakes into, and we are collaborating, like what Zebra was saying. So we have put stakes in listed company like Shalimar. We have a very strong stake in Shalimar Paints. We have acquired RDC Concrete, which is probably the only single company which operates in concrete scenarios. I think it's going to be a collaboration, and it's going to be a right time. But yes, IPO is on the cards, and maybe couple of years or 3 years.
So Mohit, what role do you think banks can play in the startup's journey towards IPO?
So I think, from a bank's perspective, while I personally feel IPO is just one of the mediums, and I take his color on it, that it's being independent, so being associated with investors, but there would be a phase in the early stage when you have to have investors in the company, and then only it will progress towards an IPO. But, from a banker's perspective, there is once there is an association with an entity, then the entire advisory or hand-holding towards an IPO also becomes a part of the banker's perspective. So, we can add our nuances from a banking perspective and help the company out from in bringing in an IPO. So all the entire services which are associated with it, we can bring on the table.
Okay. So, okay, wonderful conversation. So I hope, we have some time for open forum. In case, we have some questions to the panelists. Yeah, yes, please. Can someone get a mic to the person?
Yeah, it's a very crisp question, especially for the buzzword which is generative AI in almost every discussion I've attended. So it's primarily for all the investors and maybe Abhishek, who is heading the Tracxn, that most of the startups, especially in deep tech or fintech, they claim that, generative AI is the core of their platform which they're building. But my question to all of you is that which is one example which you have come across which is truly the application of generative AI, especially for the Indian scenarios. So most of the firms claim that they are implementing generative AI for the global market. But my question is more specifically for the Indian market, because it's very unique of its kind, that which one example is the best implementation of generative AI for Indian market?
So who's taking the question?
So maybe I'll attempt to answer the question. To be honest, at this point, a lot of the startups claiming to use generative AI don't really have a thesis on the market, at least the ones serving the Indian market. There are, I would say, B2B software startups that do seem to have a strong thesis, but consumer startups, I have come across very few that have a strong thesis on the use of generative AI. However, I've seen some good point startups. So companies that are trying to generate content through generative AI, very specifically for the Indian market. Some of those are interesting on the content or media and entertainment space. There are startups in the legal space that I've found quite interesting, who are able to use generative AI to read and summarize legal documents or find issues within legal documents. Some of those are quite interesting as well. I found one interesting a business that is using it in insurance in a way to read and summarize insurance policies using generative AI. Because a lot of those policies are not digital in our country and not standardized. So there are some isolated examples, but I would say at a broad thesis level, a lot of the companies that have got better thesis are B2B startups serving the global market.
Okay, for the paucity of time, we bring to a close this session. So thank you, panelists again.